and welcome to the VSA Capital Tech and Transitional Energy Podcast. It's Thursday, the 23rd of October. Hi, Phil. How you doing?
Very well, thank you, Andrew. Nice to join again.
Right. There's all sorts of things I can sort of introduce this with. A lot of thoughts about the whole geopolitical situation at the moment, where the world is so rapidly changing. But it's probably not tech and transitional energy. But there was one thing I just wanted to draw attention, some statistics about the UK, because we've quite regularly talked about all the data centres that are going to get built theoretically in the UK. In fact, I think our wonderful Prime Minister, who is the most loathed Prime Minister in history, I think, in terms of opinion polls, and he's going to get a nasty shock tonight probably in Wales in the Caerphilly by-election. But I think he's pledged 150 billion or something, I'm not quite sure. Anyway, a huge amount of money to build all these data centres in the UK. But the one thing that he's sort of forgetting about, you can't have a data centre unless you've got power. Now, the UK currently has 9 operational nuclear reactors at 5 sites, but virtually all of them are due to close by the end of this decade. 8 of the 9 are scheduled to close by 2030. So that's Hartlepool, scheduled to close March 2028. Heysham 1, scheduled to close March 2028. Heysham 2, scheduled to close March 2030. Torness, scheduled to close March 2030. Sizewell B, expected to close after 2030, but it'll close pretty soon. There are also 39 what are called CCGT power stations in the UK. That is combined cycle gas turbines. The design life of one of these is probably 25 to 30 years. Most of these CCGTs that we have in this country were built in the 1990s. So, in other words, most of them are about to come to an end. They've done their design life. The current lead time you want to build a new one is about 8 years, and we haven't put in a single new order. So, basically, the UK is going to run out of energy. It wouldn't surprise me, actually. Well, it is possible that we have blackouts this winter. So how the hell they hope to build all these data centres, I do not know. Any comment, Phil?
Yeah, I do actually. The nuclear reactors are what are called advanced gas-cooled reactors, very old reactor technology. But what needs to be remembered about the nuclear reactors and the gas, it's baseload power. And baseload power is steady power all the time, and that if it's an underlying layer to all the renewable energy that's variable power on the grid. So it's a really, really important factor in a whole energy supply into the UK. And we're probably going to end up importing more energy over the interconnectors to support all of these data centres that have been committed by the US multinationals otherwise.
Yeah, and unfortunately, SWB, solar wind batteries, doesn't really create baseload power because the wind and the sun comes and goes. We just don't have the battery energy storage systems around. But I mean, this is the whole point, is we basically can't fulfill all these data centers. Now, we could actually, if we started going and talking to people like Microsoft and Google, Plantier, CoreWeave, Blackstone, all these people who are pledging to build these data centers, what we need to do is go to them and say, look, I'll tell you what, guys, give us the money to build some more power generation. And that power generation actually is going to have to come probably from gas. I don't really see another option. The good news is the UK has a vast amount of gas, both in the North Sea and in shale gas, and it's the only way we're going to get these data centres, frankly, up and running. Now, don't get me wrong, I think most people know that I'm a big fan of SWB. And yes, there's plenty of wind, there's plenty of solar really in this country already. We need more energy storage through batteries. But actually, that doesn't mean to say that you can't have gas. I think what any sensible politician should be saying at the moment is we just want to have the maximum amount of energy at the lowest price possible. Unfortunately, that is not what the most dangerous man in the UK is saying at the moment. That, of course, is Ed Miliband, where he's just trying to take us totally green. No, the answer is you need all of it. And actually, without putting out a PR statement for the Reform Party, that is exactly what Reform is saying. They want to bring energy prices down, which is absolutely the right thing to do. And so they know, and people think they just support gas and that sort of thing. They don't. They also support renewable at a low cost. So there's my little introduction, a little bit of a party, political party statement. But what you've got to do is look at both sides of the argument, whatever. Anyway, I thought there was some quite interesting statistics there, even if you didn't think they were interesting. So probably as an intro, that's probably enough. Let's go on to news we've been having, Phil. Whatever your name is.
Well, we've got. You can't forget my name, Andrew. I'll have to wear a badge for this podcast, I think, so he remembers me. Right, we've got US results reporting season. Lots of talk, Andrew, in the markets about valuations, particularly in the tech sector, and AI-driven valuations. So, the these results, I think, are going to be very keenly followed as they come out. But one of the first out the doors, which was really interesting to see, was Apple. And their shares are up. I was quite surprised by this, looking at the old chart.
I wasn't actually, because my wife wants an iPhone 17.
Oh, right. Well, you were surprised about that.
And if she wants an iPhone 17, she's getting one, and obviously everyone else is following her. So no surprise to me, Phil.
Well, they do appear to be doing, yes, really outperforming Apple, and it is on demand, as Andrew points out, for iPhone 17. And there's more expected to come. Particularly as they're putting more AI features into the iPhones using its advanced AI A19 chips. But also interesting to see that their shares, Apple shares, are only up 3% year to date. Up their dip because of the tariff impact, but only up by 3%. Just looking at valuations on these US tech stocks, they're on a P of 35.6 times, forms the 32.7 times, according to Icon. But a number of commentators have said, well, at the end of the day, it's Apple. It's got that brand power and got the growth through the iPhone and the infrastructure around it. But
it's not an outrageous PE, actually. I remember back in the dot-com bubble, ARM was on a PE of 500, and yet people were trying to justify it. It didn't stay there for very long, because we then had the dot-com crash. But of course, actually, in many ways, ARM has gone on to be incredibly successful. Maybe the PE wasn't that wrong.
Well, it wasn't realised, I think, at the time necessarily by all the investors, but that it was developing its brand, that strong brand power and must-have technology to use. Where you get the valuation, and Apple is like that in terms of its brand power. Another long-established tech stock is IBM. They've reported as well, and their shares are up by 23.5% year to date. And IBM still is making computers. Mainframe does mainframe computers, but also software and consultancy. And they've reported that their software revenues were up by 10% during the quarterly period to $7.2 billion, meeting street estimates. Consulting was at $5.3 billion, and infrastructure, which is the mainframe business, was up by 17% to $3.6 billion. So, long-established tech company, still growing very, very strongly. And IBM has had that jump in share price, and its PE is 25 times, forms of 23.4.
And you don't get fired buying IBM.
You are quite correct on that one. Now, moving on to a different sector, still US reporting, Tesla. That's their results. Now, Andrew and I have spoken a lot on this podcast about what is happening in the EV market, particularly with the Chinese players and internationally, and the types of models that they're bringing out, the low-priced EVs. So Tesla reported its third quarter, and they had said that so sales overall grew very, very strongly, rose by 12% to $28.1 billion, but their profits fell. Now, part of this was because Tesla gets regulatory credits, carbon credits that it supplies to the automakers that don't have the EVs, but also its investments in newer technologies, including artificial intelligence. So that impacted their profits. But I was also interested to see, actually, Andrew, I don't know if you saw it this week, was the European September car sales were up by 11%. A lot of growth in there from the Chinese automakers now in Europe.
And there's a lot of them, a lot of Chinese coming out with a lot of very cheap vehicles. We've always said that China will be 90% Chinese EVs soon, Europe 50%, America 25%. Still stick with those predictions.
There we are, and we're already seeing it, we're starting to see it really, really happen. But in terms of reporting in the markets and for the technology companies, just to note, we've got Alphabet reporting on the 29th, Meta on the 29th of October as well, and Microsoft. Now, all of them very, very heavily exposed to AI development and huge spenders on AI technology. So be very keen to see what they are doing, what they're saying about the market traction, because obviously it's to be part of the US market.
Will they be a trick or a treat?
That's a great way of putting it. But in the meantime, people are investing. I was just interested to see some of the stats from the UK on the wealth management firms. So that's not tech and trans, but certainly in terms of markets and what's happening in market momentum. Quilter reported their third quarter results with net inflows of 2.2 billion. It's a 48% increase. I saw that AJ Bell added 100,000 new customers in the year to September, bringing their total clients to 644,000.
Schroders also saw record inflows this morning.
Did.
So, it's across the board. Money flowing into the UK. The FTSE obviously getting quite close to 10,000, which will be quite a point.
Yeah.
Won't take too much to nudge us over there. Hopefully. Fingers crossed. We want to keep going up. We prefer going up to going down.
We absolutely do. Yep. We don't want a bear market. Right. On to the UK and results, specific results here. Softcat, ticker is SCT, market cap is 3.2 billion. They reported their full year results. This is an interesting one to watch at the moment because this is an IT services company. So they're across the board. So it's providing hardware to enterprises, software, cyber, data center capacity. So they supply a big supplier to small and mid-sized businesses in the UK. Softcat is, but as well as to the public sector and enterprise. In terms of results, they reported that their gross invoiced income rose by 26.8% to 3.6 billion. So big rise there. Gross profits up by 18% to 494. But what was interesting here was their comments on the markets and where spend is coming from. And they said the mid-market space was the year's top performer, driven by data center re-engineering, obviously for AI, but they saw strong growth across enterprise and the public sector. Now their sales are I think they're quite UK focused, Softcat. So this is strong. This is corporate spend as well as government spend on tech. They further commented that in terms of the overall sales, they had a 14.8% increase in software sales, and that was strength in cyber and networking software. And we're seeing so much news on the cyberspace. Andrew and I talked about it, I think it was last week, about some of the US stocks in space, but particularly about Jaguar and the sheer financial impact of a heavy cyber attack. Clearly, businesses are taking note and spending here on cyber and networking software. Interesting enough in this set of results as well, hardware sales dropped by 75% to just under $1 billion. And this was investment in data center, networking, server, and compute sales. So again, this is this AI capital spend cycle that we're going through right now. And they highlighted that they did the customer survey, data security, the most common technology priority right now for all businesses. So that was Softcat. One we've not spoken too much about this one before. This is SRT Marine. Listed a long time. The ticker is SORA. Market cap's £204 million. The shares are up 110% year to date. Now, what do they do? This is security technology. There's the buoys that go onto boats, tracking vessels in the sea. So this is, they're used by fishery authorities, vessel owners, but it's all about managing, controlling the maritime domain. Now, as we know, and Andrew started off by talking about geopolitical issues, clearly it's not all about fishing vessel detection. There will be other marine vessels as well, and things like oil shipments, I would guess. Nonetheless, they've got a lot of traction for their tech. The year ended June, the revenues are up by just over 400% to £78 million from £14.8 million, heavily driven by its navigational safety business, but also the systems that work around that. They moved gross margins of 31%. They were increased, and they moved into profit. I think they were lost previously, and they've got cash balances of £4.3 million, and they're investing heavily in developing new products as well. In terms of this is radio products for vessel identification, so a lot of momentum behind this company now.
Well, I think maybe we need to put some of their product on the small boats in Dover before they ship them back to France, that they can be used again, which is absolutely ludicrous. That way, of course, we could detect all the small boats coming out of the Dunkirk. And we can have another mission to Dunkirk to stop the boats. Moving swiftly on.
Indeed. And then to another area of technology, Seraphim Space Investment Trust.
Yeah, actually, that's doing all right at the moment, isn't it?
SSIT is the ticker, £197 million market cap. Their NAV, I mean, this is a fund that invests in technology in space. NAV is up by 23% to £280.1 million. And the drivers in this are really, really interesting. One of their portfolios companies, ICE, I'll spell it, it's ICEYE. It's 37% of the net asset value of the fund. And they have what is called synthetic aperture radar capability. So this is technology that goes into satellites. And these are satellites that can actually see, work in daytime, nighttime, through clouds, observing all the movements below. Gaining great traction. They announced that they've signed 9-figure contracts with nation states, including a €200 million deal with the Polish Ministry of Defence. Announced collaborations with Rheinmetall Defence in Germany. And they closed the Series E funding for that company as well. So that's doing really, really well. Another area of tech, which is
actually going back to satellite. Have you ever noticed how satellites looking for intelligent life, they're always pointed away from Earth?
You got me on that.
Oh, I'm in a mischievous mood today. Keep going, Phil. If you didn't get that joke, don't worry about it. Keep going.
I had to pause for a reason on that one.
Yeah.
Right. Another of the holdings is called D-Orbit, and it's 12% of the NAV. And this is space taxi technology. It's actually clearly vessels in space that transport CubeSats, the smaller satellites, their final orbit positions. And they signed a €120 million contract with the European Space Agency to develop servicing capabilities for geo satellites. I mean, we talked about the low Earth satellites and all these smaller satellites going into space and Starlink in connection with companies like Filtronic. Anyway, nonetheless, that was the Seraphim Space Fund. And seems to be doing very, very well indeed. A company that has had its struggles is XP Power. XPP, 291 million market cap, specialised power supplies, going to the industrial space and healthcare space, and obviously we've seen differing spending patterns in those sectors that have affected the business, but seems to now be recovering. The shares are down they're down by 14% in the last 12 months at a third quarter trading update. And they said that all important order intake was up by 13% to £55.3 million. And they quote slower customer destocking, industrial technology, and healthcare. Well, actually, what it means is it's real demand now coming through on this. Expects growth to be sustained into the fourth quarter. Full-year profit in line with market expectations. So that was XP Power. Getting on to sticking with power, but battery technology. We had Gelion Battery Technology, which we've covered in a podcast before. Ticker is GELN. Market cap is £45 million. They do sulfur battery technology. The company announced a multi-year collaboration with TDK, Japanese battery company, and raised gross proceeds of £10.5 million. And then second...
And again, just on that, we have talked about it a lot. I mean, well done on the TDK collaboration. And look, the battery technology they got is very interesting. The trouble is, £10 million in today's market is a lot of money. But developing new batteries costs a huge amount of money, and that's my concern here.
Yeah, absolutely does. There are significant development costs involved. The second battery tech company was Ilika. Ticker is IKA, 90 million market cap. And the shares in Ilika have actually doubled this, just I was looking over the last 12 months. They've been doing really, really well. They develop solid state batteries. They're developing a battery called Goliath. I think this is aimed at the transport markets. And nonetheless, they've announced that the pilot line for this technology is now fully operational. I mean, the key thing about that is it's a 1.5 megawatt hour pilot line, and they can start putting out a lot more batteries and sampling customers, and also establish steady yields for the technology. So that's a step forward for Ilika.
And again, it's a very similar situation. I mean, solid-state batteries are really interesting. Ilika has some amazing technology. I've been down to their facilities in Southampton quite a few times. They actually have two different batteries. Basically, one is the Goliath for the transport. The other is a very, very small one, really good for pharmaceuticals.
That's medtech.
Yeah, that's right. Yeah. So you can put it in your pacemaker or something, it keeps going forever and you don't even know. It's really interesting, but they sort of need a big sugar daddy to really get this company going. It's a problem that a lot of UK technology companies have, full stop. We just don't have the capital available where you need to throw in like £500 million or something to really get these things in the marketplace. But yeah, look, both of those two have got very interesting technology. It's all about the capital.
It is indeed in tech, and that's for sure. I mean, just on the smaller companies front, Andrew, Hardide, tickers HDD, only 6 million market cap. Well, the shares are up 50% in the last 12 months. They're the trading update September. This is coating technologies.
I went and visited them about 8 years ago. Actually, I got a speeding ticket as well, which was annoying. Going between Oxford and Banbury, they'd just changed the speed limit on this bloody dual carriageway. Furious about it. But they have actually at last managed to get into profit, haven't they?
Yeah.
It's taken them a long time, but they got there. And coatings is very interesting. Obviously, we act for Time to Act, which has a different coatings business, very, very different. But it is a very interesting space.
It is. It's really clever engineering and use of metals. I mean, they're now increasing the amount of work that they're doing in the aerospace sector. They've got initial development revenues. This is for coating cargo door components on freight aircraft. But you've got to remember, I mean, you know more about this than me, under your chemical background. But these coatings, it's all about reducing wear, corrosion, and fatigue, which for aerospace is a big thing indeed. So and they're moving into profit. So well done to Hardide. There we are. That's about it from me, Andrew.
Very good. I don't think there's much more from me either this week. Maybe we'll do more next week. Who knows? So, very good. We'll call it a day there. Thanks, Phil.
Chat again next week, Andrew.
This podcast has been produced and edited by VSA Capital. It is intended for information purposes and not as investment advice. The information is intended for recipients who understand the risks associated with equity investments in smaller companies. Please do your own research and do not rely on a single source when making an investment decision. VSA Capital may derive fees from this content and seeks to do business with the companies mentioned.